Hello guys, welcome back to my series on applied portfolio management. And so this is lecture number 5 of a multi-part series. And today we're going to be learning all about behavioral finance. So we're going to learn about what behavioral finance is, what insights we can draw from behavioral finance, and how it might be useful to a portfolio manager. Okay, so behavioral finance is a branch of finance that applies sort of scientific research that's done in the world of psychology to the world of economics and finance. So essentially what it does is it tries to work out how humans actually behave in markets rather than just how they would be expected to behave. And this is kind of a big change for finance and economics because historically it was just assumed that people behaved in a very rational manner, that we were like computers and that we would sort of analyze decisions and always make sensible decisions. And there's some truth to that in that people generally do make reasonably sensible decisions, but there are maybe certain flaws to our thinking processes that show up in the world of finance and economics. And so there's lessons that a financial practitioner can learn by looking at behavioral finance and trying to work out what people actually do rather than what you might expect them to do. So the first thing we'll talk about then is the efficient markets hypothesis, which I believe I spoke about in last week's class as well. And this is the idea that markets, there's 3 forms of the efficient markets hypothesis that I went through before, but the overall idea is that markets are informationally efficient and that prices reflect all known information. So essentially, it's this core theory in finance that everything is correctly priced, and therefore things like technical analysis and fundamental analysis are not actually necessary because the price should already reflect all information out there. Now, the efficient markets hypothesis is used generally to justify indexing, and the idea is that if you can't beat the market by doing analysis, then you shouldn't waste your time on that, and you should just buy a diversified basket of stocks, something like an index fund, get the lowest cost version of that possible, and that's how you should invest, and really no further effort needs to go into it. And so the argument against that, well, there's a number of arguments, and over time, we've seen an awful lot of information that shows you that markets are generally efficient, and I've made that argument in prior classes, that overall markets can be seen to be reasonably efficient, and it's not a terrible argument, but there are lots of flaws within there, and there's all sorts of examples that one can draw that will show a mispricing that shouldn't occur in a rational market, but that does occur in the real world. And so even just the idea that the minute information hits markets that it's instantly priced in, well, then you wouldn't really expect to see, we'll say, all of the volatility that you might see. For example, right now, we're probably in the most volatile market that I think has ever been. Looking at the recent moves in the S&P 500, we've got over the last couple of weeks an average daily swing of around 5%, which is just way beyond what's normal. Now, if things were being priced in efficiently, the market would have recognized that, we'll say, there's this sort of oil shock and coronavirus economic issues, and the market would have quickly reflected that reality and moved on. Now, I understand as well that, of course, people are reacting to that, and there's economic stimulus packages being released and so on. But equally, the huge moves that we are seeing in markets doesn't really reflect a market that just takes information calmly and reflects it in the prices. Instead, what we're seeing is all sorts of volatility as people try and work out what a fair price is. Now, an example, a story that Warren Buffett often tells that he got from his mentor Benjamin Graham, who was Warren Buffett's teacher and first employer, is this story of Mr. Market. And apparently Benjamin Graham used to tell this story to people, that you could think of Mr. Market as a business partner that you have in a private business. And he's a bit of a crazy guy. He turns up every day and he names a price at which he'll either buy your share of the business from you at, or he'll sell his share of the business to you at. Now, Benjamin Graham and Warren Buffett go on to say that he's not there to serve you, he's not there to guide you, but his money, not his wisdom, is what you'll find useful. So essentially he's this erratic guy, and he turns up every day with a different price, a different valuation on the business, and it's your job to potentially decide to trade with him or not, either sell him the business or buy the remainder of the business from him. And, you know, basically this idea is that that's how the real market is, that the business might have steady operations. There's nothing too crazy going on in the business, but on a daily basis, this guy's coming to you with wildly different prices. And that is an argument for maybe how the market behaves, in that there's often maybe more volatility in market prices than there are in business conditions. And so Buffett then goes on to say that emotions are contagious, and emotions have no business in investing. And that's really what we're going to talk about in today's class on behavioral finance. We're going to look at what kind of human emotions do we have that play into our investing behavior, and is there anything we can do to make maybe more rational decisions? So the mistakes investors make. Well, you know, an example here is a great example actually taken from a book called Market Sense and Nonsense by Jack Schwager that I recommended in an earlier video, and I'll put a link to it below. And this is a really, really interesting book. But Jack Schwager used to do research in one of his earlier jobs on CTAs, commodity trading advisors, which is a type of hedge fund that trades in futures and options. And a thing that puzzled him was why so many investors lose money even when they select one of the best CTAs. And this is kind of a puzzle. And Schweiger basically worked out that even if you found like the best possible investment, the best of the CTAs out there with hindsight, and you looked at how the investors behaved, you would find that the average investor is able to turn that great winner into a break-even bet or even a losing bet. And the reason for that is that they just get carried away, and they always add money after good performance. They always pull money after a bad period, and that their overall realized return is actually way worse than the return of the investment, you know. And this is based in real data. This isn't a theory of Schweiger's, because the CFTC, which regulates CTAs in the United States, requires them to disclose not just their returns, but the return that their investors get when they invest and when they pull their money. And you'll see in some of the really best CTAs, some investors seem to be able to just get awful returns out of them. And my old boss, Victor Niederhofer, in his book Education of a Speculator, he kind of joked about I think it was his cousin, and he referred to him as a man who could always drag defeat from the jaws of victory. That he was a guy who always would do the wrong thing. And the truth is that in markets, often investors do the wrong thing. You know, you even see right now, you're seeing, if you read the news, that a lot of the funds out there, not hedge funds necessarily, mutual funds or whatever it might be, or just investment accounts, people are pulling their money out. Now, the truth is that that's probably not an overall good strategy, is to always add at the highs, like wait till there's been 5 good up years and pile in, and then the minute there's a downtick, pull out. But that's what people do, and there's a variety of reasons why people do that. And to some extent, I would argue that a big part of being a good investor is being able to manage and control your emotions, because even the best investors that I've met have said to me that they have a constant urge to do the wrong thing. They've just over time learned not to do that. And so what else have we got here? Well, Here's a kind of an interesting, another interesting piece that sort of plays into behavioral finance, or plays into people not getting the returns that maybe they should. A friend of mine named Victor Haghani, who was a former partner at Long-Term Capital Management, and now he runs a business called Elm, I think it's called Elm Partners in the UK. He put up, actually we'll look at two of his pieces of research today, but he put up a few years ago, he did a TED Talk where he asked the question, where are all the billionaires today? And he argues that if you had taken $1 million in 1900 and put that in a representative basket of stocks, or invested it in the Dow Jones or the S&P 500 or some sort of passive investment, that money would have grown into $65 billion today. So he kind of asked the question, like, where has all this money gone? And he points out that there were 4,000 millionaires in the US in 1900, because obviously, a million back then was like a billion today. Maybe there were 4,000 of them in the US in 1900. And he says that if each of those families of millionaires had children at the average rate, and so we moved down a few generations, and they had indexed their $1 million, or 1 million of their fortune, right? Because just to be a millionaire means that you have 1 million or more. So if they had put away 1 million and had a normal rate of childbirth in their families, there would be 120,000 billionaire families today who inherited all of that wealth. So essentially, what Victor is asking is, where did all the money go? Now, of course, he agrees there's lots of good answers to that question. People spend some of their money. They don't just invest it all. But his real argument is that actually, once again, people kind of do the wrong thing, because that's an awful lot of billionaires that do not exist today, that in theory could. And it just relates to people possibly not getting the kind of return out of the market that the market provides. It sort of overlaps with Jack Schwager's argument that either people are underinvesting, or that they are maybe taking money out at the wrong times. Maybe they're investing in the wrong things, or maybe they're paying too much in fees, because maybe their broker has made a fortune off of them and they haven't done that well. And so that's kind of a question to ask. Like, if doing next to nothing by indexing will turn your $1 million into $65 billion today, how come people don't necessarily have more money than they should? And you can probably even look at your own retirement accounts or whatever that way and say, had I just X number of years ago done a really boring thing and indexed, I might be better off than I am right now. And so let's talk about the mistakes then that people actually make. Well, firstly, let's just give a few examples of behavioral studies. Like, what are these behavioral studies that we're talking about? So there's a bunch of things like seasonality in stocks, things like the January effect. Now, interestingly enough, I did, my thesis advisor at London Business School was Elroy Dimson, who was one of the people who sort of found the January effect. And one of the last times I met Elroy, he was quite funny about this, because he said that he wrote a paper saying that there was this January effect, and then everyone started trading it, and then the January effect disappeared. And so a few years ago, he wrote another paper saying that the January effect has now disappeared and doesn't work anymore. And he said it pretty instantly started working again. But there's all these kind of January effect, turn a month effect, weekend effects that relate to ideas that maybe people make very simple decisions. Like at the start of the year, they decide to, New Year's resolution, I'm going to invest, and that might push up certain stocks. The turn of the month is just the idea. I think this has disappeared, but it used to be a thing. An awful lot of investors would just have their retirement account contribution occur at the start of the month. They'd just pick a date, the first day of every month, and they'd have the money go in. And what was happening was that it was pushing up the returns of the market on the turn of the month. So then a lot of people started buying stocks on the last day of the month in order to exit on the first day of the month, taking advantage of that trade. Other things like momentum in stocks. So there's things like post-earnings announcement drift. There's things like merger arbitrage. None of these should actually work in the real world if markets were truly efficient. There's even other ones. One of the more interesting ones was many years ago when I started out in finance. There was a company called 3Com that launched another firm that was called Palm, that built what was called a Palm Pilot, which was kind of an early handheld computer. It was in all honesty, it was an utterly useless thing, but everyone thought it was cool at the time. This was the hot thing of the late 1990s anyhow. And so 3Com spun off Palm as a separate company, but they held on to most of the shares, so they only spun out a small amount of it. And the stock of Palm went way up and 3Com languished. Now, in truth, if you owned one share of 3Com, you owned about 1.5 shares of Palm, just because they owned that much of the stock of Palm. And so it made no sense. And there were lots of news articles at the time, and everyone was discussing, why does this happen? Like, shouldn't everyone be buying 3Com and selling Palm? But the market just did what the market did, and people were excited about Palm and not excited about a company they hadn't heard of that happened to own most of Palm. So once again, in a truly efficient market, like if the efficient market hypothesis held, that couldn't happen, right? What else have we got? Well, even in the world of gambling, there's research on how people betting a win on a favorite in horse racing have higher average returns than long shots in horse betting, and bets on unpopular numbers have higher returns in lotteries. And that relates to the idea that if you pick an unpopular number, you're less likely to have to share the prize than you are if you pick the most commonly picked numbers. And then even things like in foreign exchange, the carry trade, where you're able to borrow currency in a low yielding country, convert it into another currency and invest it at a higher interest rate and earn a positive return on that. And that sort of currency carry trade shouldn't work in a purely efficient market, but it is a source of returns for foreign exchange investors. So once again, these are just a quick glimpse at little holes that exist in the efficient markets hypothesis. Now, once again, I'm not saying that the whole efficient markets hypothesis is rubbish. I'm just saying that it's not perfect, that there are examples of it not working the way you would expect it to. So, is this stuff then convincing evidence against the efficient markets hypothesis? Well, there are certain concerns that people have when you bring up these problems, and they say, well, maybe you're not controlling correctly for risk. Like maybe these things that have a positive expected return, if you risk adjust them, you wouldn't find that you're getting a positive risk adjusted return. I'm not sure that holds on all of the examples. Some people are saying that a lot of the effects that are found in behavioral finance are statistically insignificant, and there is actually just a general problem in a lot of economic and social science research. In fact, I have a statistics book coming out shortly where I look at this idea where an awful lot of academic papers that get published, they'll sort of find these anomalies, and then in the real world, these anomalies are never replicated again. And so the question is, have these people actually found real anomalies, or have they just found what's referred to as an artifact of the data? And so that is a big criticism that's often pointed at the world of behavioral finance, is that the findings always look more exciting than the return stream does when people actually trade this stuff. And then a final argument that people make is that, yes, maybe these inefficiencies do exist, but they are economically insignificant. In general, you're probably still better off just indexing, is the argument that's made in that case. So let's move on, and we'll just talk about what mistakes people actually make, and we'll see if there's anything useful we can learn from this. So The first thing we're going to look at is what are called heuristics, which are kind of rules of thumb. You know, that's why I have rules of thumb up here. They're simple rules that, people argue are hard-coded either through evolutionary processes or they might even be learned, which have been proposed to explain how people make decisions. And these rules work well under many circumstances. So as you can imagine, it's sort of like, if you go to the supermarket and you want to buy a cheaper box of cornflakes, for example, you might usually have a rule in your head that that the store brand is always cheaper than the sort of well-known, the popular brand of cornflakes, we'll say. And so maybe instead of reading the prices, you always just go in and grab the store brand one because you want to save a little bit of money. But of course, maybe you should read the prices every time. That's kind of an argument that maybe the reason we make all of these shortcuts and these rules of thumb are just really out of efficiency. And I know that I very much do that in that there's certain things that I just decide are good ways of approaching things, and I can't invest too much time in the details of every financial decision. So what kind of heuristics are there? Well, there's prospect theory, there's loss aversion, there's status quo bias, there's gambler's fallacy, there's overconfidence, and there's the money illusion. And so we're going to look at all of these heuristics and we're going to see what is it that people seem to do wrong, and is there something that we can do to not make the mistakes that other people accidentally make. So prospect theory, and actually an awful lot of the field of behavioral finance comes from these two guys, Kahneman and Tversky. And prospect theory is a theory that describes decisions between alternatives that involve risk where the probabilities are known. So the model is descriptive and it just tries to work out how people actually behave, like how people think about risk, because we know mathematically how they should think about risk, but how do people actually feel? Do they behave differently than a model might suggest they should behave? So here's one of the first examples. So one of the first studies done in prospect theory by Kahneman and Tversky was where they asked people to choose between the two following gambles. So you can pick one of these two things. You can have 100% chance of getting $1 million, which is great, or you can have a 10% chance of receiving 5 million, an 89% chance of receiving 1 million, and a 1% chance of receiving nothing. Now, we can do the mathematics and we can just multiply 10% times 5 million, 89% times 1 million, and 1% times 0, add them all up, and that will tell us the fair value of that bet. And, you might expect people to do that. Now, we'll move on though, and we'll say then they're asked a second question. So once they've made their first choice, they're then given another two choices where they're given these two gambles and asked to choose between them. So an 11% chance of receiving 1 million, or an 89% chance of receiving nothing, or a 10% chance of receiving 5 million, and a 90% chance of receiving nothing. So you're given these two bets again, and as I've said, you would just multiply the probability times the payout, add them all up, and that would be the fair value of those bets. And a gambler would probably make the right decision. They would make the optimal decision, which is to take whichever of the bets has the highest expected value. But what do people actually do? Well, the value of bet A is $1 million, and that's pretty obvious because it was, there was no gamble. You were just going to be paid $1 million. The value of bet B is $1.39 million. So actually, that's a significant increase, right? Because you had, what was the chance? It was 10% chance of getting 5 million, but of course you equally had that 1% chance of getting nothing. And when you multiply that out, it's 1.39 million. Now, you might think as a finance student or as an investor or someone interested in investing that you would make the correct decision there. And, hopefully you would, but that's not what people do necessarily. And so a lot of people do choose A over B. And the argument that Kahneman and Tversky came up with was that maybe these people were maximizing expected utility, right? Because a guaranteed $1 million was just going to change their life hugely and make their life so much better, and they would be wealthy. And the small chance that you don't get that just didn't seem worthwhile, because that maybe people just thought, well, what's the difference between being worth $1 million and 1.39 million? Either way, you're well off, and I just don't want to risk that 1% chance of getting nothing. So more people than you would expect would choose bet A. Now the next two bets, the value of bet C is 110,000 and bet D is 500,000. And so you would think that the kind of person who is a utility maximizer, the kind of person who picked bet A, would prefer C to D. Because if you were maximizing expected value, you'd prefer D to C. But often you find that a person's choice in the first stage is inconsistent with their choice in the second stage. And so what we're learning is that the relationship that people have between, risk and return, or any of these ideas, or even just the idea of an investor optimizing, they tend not to do that, or they tend not to do it very well. And the outcomes are maybe a little bit inconsistent. And so the first thing that came out of prospect theory from Kahneman and Tversky was this, which is called the value function. And what we see here is that essentially that the value is on this axis, and then we've got gain over here and loss over here. So that's a return of 0. And the idea is that people really value the early gains, the small amounts that they gain. And then as they get more and more, they sort of value it a little bit less. And this ties into the sort of idea in economics of diminishing marginal utility, that sort of one hamburger might make you happy, and 2 hamburgers might make you happy, but not maybe twice as happy as 1 hamburger, while 100 hamburgers is just too many, right? And so essentially the more you get, the less you appreciate it, is kind of what we're seeing here on the top half of the graph relating to gains. But what's interesting here is that we have this huge drop down to begin with in relation to losses. So it actually is telling you that it sort of hurts people, or they get a real feeling of negative value associated with a small loss when they don't get the same kind of joy out of a small gain. And we've got here, marked up the 5-cent gain, and you're coming in here at around, 18 or so of value, and the 5-cent loss, sort of a pain of around 40 on that axis. So we find it way more unpleasant, almost twice, probably a little over twice as unpleasant to lose a small amount than we do to gain a small amount. And you might find that in yourself, that if you were out in the street and you found a pound coin, that might make you a little bit happy. But if you realized you had lost one of your pound coins, it might make you more unhappy, and maybe you feel foolish and that you're not doing things the way you should, and that upsets you. And so what Kahneman and Tversky found was this value function passes through the reference point, and that's sort of a point of 0, but it's not exactly a point of 0. We'll talk more about that in a minute. But basically the value function is steeper for losses than it is for gain, indicating that losses weigh more on us than gains do. And so here's an example of that, where Kahneman and Tversky did this study where a $3,000 gain, you get a choice between either getting $3,000 or an 80% chance of $4,000 gain and a 20% chance of no gain. So once again, this is like our first bet, where the second bet is a better one, in that it has a higher expected value, but of course you are running the risk of not making anything. And so that's one choice. And then choice 2 is a $3,000 loss or an 80% chance of a $4,000 loss and a 20% chance of no loss. So this is the exact opposite of the prior one, right? And what you find, or what they found, is that way more people just pick the $3,000 gain. They just want that sure gain. That appeals to them. But on the loss side, they actually take the gamble, right? Even though that has, if you multiply it out, it's actually got a negative present value greater than the $3,000 loss. But what this is telling you is that people don't necessarily feel a need to gamble for wins, but when they're losing, they often will gamble in order to get back to break even. And that's something that's very much seen at casinos, and it's also seen in the world of investing, where often in fact it's a worrying sign in certain investors that the minute they lose money they massively up their risk, and it's something that people who allocate to funds look out for, because it's a very worrying thing, that essentially the idea of doubling down on losses and that sort of thing. So that was the value function. And the next thing from Kahneman and Tversky is the weighting function. And so the weighting function is sort of showing you the weight that someone puts on a decision and then its probability. And you would expect there to be a straight line like there is here, but instead there's this curved function once again. So what does this tell us about people? Well, it essentially is telling you that people, instead of sort of viewing it as a continuous linear kind of function, the way the human mind seems to work is almost as if there's just three probabilities, which is can't happen, might happen, definitely will happen. And they can't, they don't deal very well with the in-between. Like they're way off at the line at every point other than sort of can't happen and definitely will happen. And so what does that tell you about people? Well, it tells you that maybe we worry too little, maybe about small risks. Well, no, what does it mean? It means that, it just means that we're misweighing our risks. And actually a good example of misweighing your risks would be, we'll say, for example, I talk about this in other classes, when people buy, we'll say something like a mobile phone or a computer or something like that at a store like Best Buy, and they go in and they buy this product, and it might not cost that much. It might cost like $100 or something like that. And then what they'll do, the salesperson will ask them, would you like to buy an insurance policy on that? And people will insure that. And it doesn't make sense to buy insurance policies like that, apart from the fact that they're usually horribly mispriced. It doesn't make sense to insure yourself against a really manageable loss. You should really just be insuring yourself against significant losses that will change the way you have to live. And so essentially people don't deal awfully well with probabilities of events, where they instead of weighing them sort of continuously as you might hope someone would, it's broken down into these sort of three ideas. So prospect theory in general. By the way, I should explain why it's called prospect theory. It's called that because they thought of it in terms of prospects or gambles, and basically the idea was to see how people made decisions when money was at risk in the way that they make decisions when gambling or when investing. And so prospect theory helps to explain why investors hold on to losing stocks, why people take more risks to avoid losses than to realize gains, and it shows us how investors might stay in a risky stock position hoping for a bounce back, or gamblers on a losing streak will sort of double up their bets or increase their risk or their volatility in order to try to get back to even. And it's because they're trying to avoid the horrible feeling of having lost. And so that's an interesting thing that we can take away from prospect theory. Now, what's useful about some of this stuff, you might think, well, if I'm just telling you it's a human behavior, maybe there's nothing that we can do about that. But that's not actually what happens. What happens is that when you tell people about the kind of obvious mistakes that they make, if they can understand the mistake, if it's not overly mathematical or technical for them, they then go and adjust their behavior, and they don't make that mistake going forward. So hopefully, the benefit of watching a video like this is that you will learn the sort of maybe foolishly pre-wired mistakes that we make, and at least when it matters to you, you can try to not make those kinds of mistakes. So loss aversion refers to people's tendency to prefer avoiding losses to acquiring gains. And some studies like the Kahneman and Tversky one suggest that losses are twice as powerful psychologically as gains. And so this then ties into things like sunk costs in businesses, where a businessman might have put a certain amount of money into a business plan. That is wiped out. We'll say if it was, if the person was going to, they bought a plot of land and they were going to develop it into an apartment complex or something like that. And so they spent a lot of money on engineering and on architects and designers and all sorts of things. And then maybe the house market crashed and they realized that they couldn't, that this was no longer a good business idea. Now, you would argue it's strategically correct to view sunk costs as, that's money that's gone, and you just have to ask yourself, should I, if I started today, would I put new money down in a project like this? Now, the problem is that people can't get away from that idea trying to claw back their losses. So although an individual should make one decision, they often make the other decision, and they feel they've committed a lot of time or energy to something, and they find it impossible to decide not to go ahead with it because no one wants to walk away and leave money on the table, and they feel they can maybe fight to get it back. So that is one thing we learn. So you can equally see this in things like option pricing, for example. So if we look at option prices on stocks, for example, we see this, there's a smile or a skew, and I won't get into too much of what that is in this class. I have other derivatives classes that explain that idea. But essentially what we're seeing here is that out of the money puts tend to be much more expensive than at the money or in the money puts. Now, there are good reasons for a smile to exist, or maybe a skew to exist, and I explain that in other videos, and it relates to the idea that the wrong distribution, that we shouldn't be using a normal distribution to price options. We have to take fatter tails into account. But the question you have to ask is, if the probability of a big up move is also as likely as the probability of a big down move, why is it that people pay more for these out of the money puts, like so much more for them than for out of the money call options? And it relates to this idea that if a put option, buying a put, is like buying an insurance policy on your stock portfolio, people are more afraid of big losses than they are excited by big gains. At least, that is an argument that can be made when looking at the skew in option prices. So what else have we got? The status quo bias. So the status quo bias is a cognitive bias which leads people to prefer that things remain the same or change as little as possible if they have to be altered. And so essentially people are resistant to change, and I think we all know this. We can spot it in ourselves, and we can spot it in our friends and family members. And this explains a lot of things, like why people often make very conservative financial choices, for example. People have this urge just to keep things the same, and this can cause people to lose out. So, for example, a lot of times someone will have we'll say, for example, if someone inherits a portfolio of stocks, or not a portfolio of investments, so there might be stocks, bonds, and cash in there, and there will be an asset allocation. Now, if you inherited it from a very conservative person, it might be mostly in bonds and cash. If you inherited it from a very aggressive investor, it might be all in stocks. And the idea is that you would be expected over time to adjust that asset allocation to match your risk preference, but people tend not to. And it's not, some of the reason for that might be taxes, in that you don't want to sell things that are up and incur capital gains taxes. But what about the very conservative portfolio? Like if you're 25 and you inherit a trust fund that's 90% in bonds, you would think it would, over time, you would want to move it more into stocks, but people tend not to. They tend to leave things the same. And so it's worth examining your own thought processes and asking, are you avoiding change because you're afraid of change, or because you just are, you don't enjoy the idea of making a decision which then might turn out to be wrong? If that's the case, you need to re-examine your thought process around investing. So hopefully that's a useful idea to you. So there's an example here to illustrate this, of a company that changed its retirement plan for new employees. So the old policy was that employees had to wait a year to be eligible to participate in the retirement fund, and then they'd have to fill out the paperwork for the contributions to begin, and they'd have to come up with an asset allocation. That was the first policy. Then they changed the policy where employees were automatically enrolled. So you had to specifically say that you wanted to be unenrolled, for a 3% contribution into a money market fund. Now that is excessively conservative. Like, you're not going to retire on that. But if you didn't want to contribute the 3%, you had to fill out paperwork to unenroll. And what they found was the contribution rate jumped from 37% to 86%. So just the fact that people were sort of told that this is the normal thing to do meant that people did it. And they also maybe just didn't feel like filling out the paperwork to say that they didn't want to do that. Nonetheless, though, employee asset allocation was still too conservative because they were still in cash rather than in maybe a higher returning investment product. So uses of status quo bias. So in marketing, a lot of businesses will use trial periods and rebates to try and get people to sign up for something and then not cancel it. And often investors, as I've just mentioned, are unwilling to change their portfolios due to this inertia. So it's worth looking out for this in yourself and trying to avoid it. Now, actually, an interesting thing here in the use of trial periods and so on, there are a number of examples, of course, like with all of this behavioral finance stuff. There are great examples out there of how companies can take advantage of these biases in order to be more profitable. And what's kind of interesting is that you find that they don't overdo that, because in a way you would maybe imagine that if a business was able to work out that their customers made this sort of foolish mistake over and over again and they could take advantage of it, they could maybe be more profitable. But what you find in the real world is that businesses do know a bit about these things, but they tend not to abuse them simply because they think more about the sort of long-term customer relationship rather than maybe ripping people off in the short term. Now, there are examples, as I've said, the use of a trial period is sort of an example of a way of roping people in and sort of hoping then that they won't cancel. And even other things like gift cards. A lot of businesses know that at Christmas someone will buy like a book voucher for a family member and give them to them. And an awful lot of the time those things are never cashed, and so it's almost free money to the business. There are things like that, and even other behavioral biases, like the way that things are often priced at $9.99 rather than $10 because it sounds cheaper and thus is more attractive to people. And everyone knows about that. I know that when I look at something priced at $9.99 in my head, I instantly just say 10. I always just round up, and I imagine most people, or a lot of people, do. But that is an example of a business slightly taking advantage of a behavioral bias, but it's not a huge abuse. And so actually it's worth pointing out that actually being nice and being kind to people is kind of a behavioral bias. It's how humans get by in the world, and we tend to be good to each other, we tend to be kind, we help out, and we don't take advantage of each other to a huge extent. And in a way that is a behavioral bias. It's a mistake that we're making in a way, in that if you were trying to be purely an economic creature, you would just look for ways of maximizing your wealth rather than ways of being decent. But the truth is that people like to think of themselves as good people, and they like to think of themselves as being admirable and decent. And so for that reason, they don't like to. People feel bad if they, rip someone else off or do something that's dishonest or unfair. And society equally does reward people for that. So you often notice the people who move up in the world are often people that are generally viewed. Now, that doesn't mean they actually are, but they're generally viewed as being honest and decent people, and that's who people hire in to manage a firm or to who they promote in the office or whatever it might be. So it's sort of it's both the behavioral bias that we maybe if we were being purely economical, we wouldn't be as decent as we actually are, but equally we do get rewarded maybe in the long term for that honesty and decent behavior. So what else have we got? Another bias here is gambler's fallacy. And this is sort of a thing that it's surprising how many people, even if you explain it to them, they don't fully agree with you that this is a reasonable way of thinking. But so the gambler's fallacy is a belief that deviations from expected behavior, once they're seen, people feel that they're likely to even out. So by that, what I mean by that is if you tell someone that there's a 50-50 chance of a coin flipping heads or tails, and you flip the coin once and it comes up heads, and you ask them what'll the next one be, and they think that there's a greater than 50% chance of it being tails, because they think that it has to really kind of quickly average out to the 50-50, while of course these are independent. So the next flip, the coin has no memory. It doesn't know what it did the last time. So the next one will once again be a 50-50 chance. There's no advantage in either direction. And often you'll see people, casinos observe people betting in this manner, where they'll watch the roulette wheel spin and they'll say, well, it's come up red 10 times in a row. It's due to come up black now, and they'll bet that way. And of course, each time it is random. And also, long runs are to be expected. Like people also, they don't really understand what a random series looks like. They often think that a random series looks more like heads, tails, and that it won't go heads, tails, tails. Or, that there won't be runs like that, I guess. So that is a mistake that people make. In the world of investing, how does this work out? Well, investors are told, if you look at almost any financial website or product, there's usually something there saying that past performance is not predictive of future performance. You're given this reminder when you invest, but still people always pick what's up. They want the guy who did the best recently. And so investors typically invest in funds that have done extremely well in recent periods. And that's just the way that people think, and that is the gambler's fallacy. And to a certain extent, you almost can't explain that to people. And that relates back to our earlier example from Jack Schwager about people investing, adding more money to a fund after it had done well and pulling money after it had done badly, and essentially turning a winner into a loser by their constant changing of their size of their investment. So here's another really interesting story and example. There's sort of two articles that you can look up about this if you're interested in it. One is written by Victor Haghani at Elm Partners, and he did this original study. He's a friend of mine, and he spoke at the conference I do every year at King's College London. I think it was 2 years ago, and a wonderful presentation. And then there's also Ewan Kirk, another friend of mine who's a fund manager at a firm called Cantab. And Ewan wrote, read the original piece and wrote an additional add-on piece about it that was very interesting. So the coin flipping experiment that was done by Victor Haghani, he basically sat a bunch of people down and told them that we're going to do this computer-generated coin flip, and it's a biased coin. Okay, so 60% of the time, the coin will come up heads. Now, you're given $25 to start with, and you get to keep whatever your gains are. It's capped at $250 simply because actually if you played this really well, you could walk away with rather significant sums of money, and you can place any size of bet. So the few things that we're looking at is firstly kind of how people approach this and how much of their $25 do they put down, right? Because it's a 50-50 chance, and if you put the entire 25 down, you're risking being wiped out on one bet. And so there should be an optimal, a smaller amount. Now if you're betting $1 every time, it's probably too small to maximize your gains. If you're putting the whole 25 down, you're probably betting too big and risking being wiped out. Now, there is an optimal strategy, and I might do a video on this in a little while. It's called the Kelly criterion, and if you're interested in that, you can Google it. And this system, if you followed the Kelly criterion of correct bet sizing based on the odds that you're given on this bet, you would have a 95% chance of winning the $250. So you're kind of going to walk away with this with this $250. So that is the optimal approach, and it involves starting with a bet size of around $5, and then as you win, you proportionally increase your bets, and as you lose, you proportionally decrease your bets, always betting a fixed percentage, and that should maximize your gain. So the people weren't given the calculation, they just had to do what seemed wise to them. Let's see what they did. So 79%, so almost 80%, failed to reach the $250. So most people did not bet optimally or anything near optimally. 28% went bust. Now that shouldn't really happen. Like if you've got a 60% chance of winning, you're not doing a great job if you go bust on this bet. 2/3 of players bet on tails at least once. Now that's the craziest part, right? Because you've been told that 6 out of 10 times it's going to come up heads, but it actually just shows that people kind of want to gamble, or it relates back to the gambler's fallacy. Maybe they'd seen an awful lot of heads and they thought it's about time it came up tails, or I can tell I'm in sync with this random number generator in a computer, but so 2/3 of people bet on tails at least once. 50% of people did it more than 5 times. Like you've been told there's a 60% chance of it coming up on heads. You should never bet on anything other than heads. It makes no sense, but it's what people do or did or do. It's a mistake that people make. 18% bet everything on one toss, right? So this relates probably to the people going bust. I think they viewed it as being bust if you got down to $2 or less. So that, but 18% bet everything on one toss, which once again, that's not good risk management. And so you might say, well, who are these crazy people that made all of these mistakes? Well, there were 61 participants. They were either finance and economics students or young financial industry professionals. So they were kind of, 22 to 25-year-old people with a good interest in finance and kind of with the knowledge to not make these mistakes. So if that's what these people do, what happens if you take a bunch of the sort of more average people who don't even maybe understand the concepts of probability or that there might be an optimal betting size? So that's a fascinating experiment, and actually I shouldn't have ruined it by telling you about Kelly criterion and the roughly what the correct bet to start with is. But if you Google it, it's I think on Elm Partners website. There's a computer version of it that you can play, not for money anymore. You have to just play the simulation, but it is a thing that you can do if you want to see how you do on it. So what have we got? So overconfidence bias then is our next one. People attribute their successes to internal or personal factors, but attribute their failures to situational factors beyond their control. So this is sort of a standard thing. And this is, the example that's often given of overconfidence bias is the idea, you've probably heard this, that more than half of people think that they're in the top 50% of good drivers, for example. Like everyone thinks they're sort of the best at whatever it is that they do. And once you hear about this, you know not to fall for this overconfidence bias. So now, if someone asks me if I think I'm in the top half or bottom half of drivers, I always tell them that I think I'm probably about average, but secretly I think I'm in the top half. I just don't tell them, that's all. Anyhow, so, people attribute their successes. It's kind of this idea that if I'm right, I was smart. And if someone I don't like was right, well, then they got lucky, And this is really how people think. And so we look at, what is this example here? In 1976, the College Board attached a survey to the SAT exams, which is an exam done by Americans at the end of high school. And it asked them to rate themselves relative to the rest of the sample. So how do you think you did relative to the rest of the people doing this exam? But they, not relative to the exam, it was added on to the exam. It asked them, how do you think you are with relation to a bunch of kind of positive but random characteristics, things like leadership ability or, general niceness or whatever, like just sort of vague but positive characteristics. And they found that 70% thought that they were in the top half. Things like the ability to get on well with others, 85% thought they were in the top half of that. And 25% thought they were in the top 1%, okay? That tells you that people just aren't very good at, judging even where they fit. And this is probably a good thing. Well, no, there's a balance, right? In that there's probably pros and cons to this, in that maybe the fact that people are overconfident means that they go out in the world and they do exciting things, and they start businesses, or they apply for a job that they're unqualified for, and maybe they'll get it anyhow. And maybe being a bit overconfident is just good for you, right? Because you go out and you take a chance to the upside. But equally, it's problematic in that it's worth knowing that you're maybe not that good at assessing, how good you are at things. And not only that, it also relates to how well you assess your friends, right? Because you assume that you choose the best kind of people, right? That all of your friends, like if you look around the classroom and you think of the 5 people that you're friends with, they happen to be the 5 best people in the class for whatever characteristics you've decided matter. And there's sort of a slightly flawed idea that maybe if you we'll say, for example, if you think that if you just happen to know all the best people in the world, or the people who are likely to be the most successful out there, and it's just that you're kind of tying it to your own ego, that you're a good judge of character, and also that you attract the right kind of people. But the truth is that on average, your friends are going to be average as well, right? That's going to be the way it is. That odds are that your best friend won't go on to be the president of a country, and the next best friend will run the Federal Reserve or whatever it might be. Odds are they'll end up as accountants or something. Just sort of somewhere towards the middle. And so the effect apparently also is greater the more ambiguous the attribute. So if it's something really tied down, like actually on exam scores, the problem is that if you've done enough exams, you kind of know where you fit in the class. You sort of know whether you are at the top or the bottom half of the class. But in terms of like school spirit or something like that, you really, that's something that doesn't have an awful lot of meaning. And so therefore you will probably assess yourself way off the charts of what is actually reasonable. So the next thing here is money illusion. And this is one of the more understandable mistakes that people make, but it's still worth not making this mistake. So this is the tendency to think in nominal rather than in real terms, to sort of think, we'll say, if an example in the derivatives class I teach, there's a financial product called a structured product, where you put money in and they guarantee that you'll get that money back. So the idea is that there's no way you can lose money. Now, of course, what's happening is you put your money in and 5 years later, if you put 1,000 in, 5 years later, you get 1,000 back. The truth is that you've lost money because 1,000 years in 5 years' time will have been eroded by inflation, or at least in a normal economic environment where there is inflation. And so there's a tendency to think in nominal rather than real terms, real meaning inflation adjusted terms. So if you actually, even a while ago, there was someone was talking about buying an old Ford Mustang, and he said to me, the Fox body Mustang, it traded at around 12,000 new, and now they cost around 12,000. So if you bought that, you've lost no money. That car didn't depreciate, and it's like, well, there's a big difference between 12,000 in 1992 and 12,000 today. And of course, and then don't get me started on all the repair bills and other things. And equally the fact that you could have put that money into, we'll say, the stock market back in 1992 and had way more money, So it's, but sometimes people like thinking in nominal terms, and it sort of makes them feel, it sort of maybe makes us feel good about certain things. But so examples of this is, it's often why nominal prices are slow to change even when inflation occurs. So you'll often see, an example would be things like, the Wendy's hamburger chain in the United States, and they have this 99-cent menu. And, sort of 20 years ago when I was a kid, you'd get sort of a decent hamburger for 99 cents. And now it's about this big, because they can't move the price up because people are tied into the idea of a 99-cent hamburger. And so they just keep making it smaller and smaller. So now you have to buy 3 of them in order to get fed. But, this price stickiness is a thing that occurs because people are tied to nominal rather than inflation adjusted ideas. Contracts and laws are not indexed to inflation. This is sort of a thing that always amazes me. Years ago, I remember talking to someone and they were putting together a will, and they were leaving a certain amount of money to one child and they bought a house for one child and wanted to leave the cash equivalent of that to the other child upon their death. And I said to them, well, you should maybe put it in that it's inflation adjusted. So if a house today costs this amount, you take that amount and you have it sort of either allocated to a bond fund and have that passed on to the child, or just have an inflation calculation put in the will. And they went to the lawyer, and the lawyer said, no, we can't do an inflation calculation. You have to leave a rounded dollar amount. And so that's what they did. But it's kind of amazing that, that things like laws and contracts and so on often don't include an inflation adjustment when it really makes sense. And often even, it sort of suits employers that it doesn't, but often when an employee is asking for a raise, they'll go to their boss and they'll say, I've been here for 3 years and I'm still earning the same amount, and inflation over that period has been this, and for that reason you should give me a raise. It's a good argument to be able to make, and it's reasonable. But anyhow, what else have we got? So just even in things like social discourse, there's often an awful lot of confusion over real versus nominal value, right? And, you'll note that I didn't make that mistake when I talked about a millionaire in 1900. And I did point out that would be equivalent to a much larger amount today, because $1 million 120 years ago was significantly more than it is today. But other people might have made that mistake. Okay, so what else have we got? Confirmation bias. So confirmation bias is a tendency to confirm your preconceptions independently of whether or not they're true. So they've done research on this, like we'll say, if someone goes out and they buy a new camera, and they might even just wander into the store and pick the one that looks the coolest, and they take it home, and then they go home and look up reviews, and they'll kind of search out positive reviews. They'll Google the name of the camera and with the word best camera after it, in order to make sure that they find stuff that says that they made a good decision. And there's lots of you'll see this in yourself and in other people, this urge to confirm that you were right. If you make a statement, you're tied to it. And actually it's even seen in politics, where it's often good for your head not to think of yourself as, we'll say, a conservative or a liberal or a Republican or Democrat or whatever it might be in your country, simply because what often happens to people is once they decide that they're a Republican, they then people can say to them, well, Republicans think this, do you think that? And they'll go, yes, that's how I feel. And it's not good thinking, to think that way. And there's even an example from 2009. There was a big scandal in environmental science where a bunch of researchers, I think it was at the University of East Anglia, some of their emails were released, and they were kind of coming up with, well, what if we do this research and it finds that pollution isn't as bad as we thought it was? And they're like, well, we'll cross that bridge when we get to it. But there was almost a discussion of like how they would hide results that didn't agree with their purpose in life, which was to find that the environment is getting destroyed. There were even talks about how to destroy the careers of people who were publishing papers that disagreed with their papers. And of course, this isn't a wise way to live. The purpose of doing research is to learn. It's to find things, to find new things. And so I often refer to this as results-oriented research, where if someone decides what they want to find, then they'll do the research to find specifically that. But it's not actually research. It's just confirmation bias. So what else have we got here? Mental accounting. So people have a tendency to keep mental accounts that aren't rational, and everyone does this. The idea that we'll say, for example, we'll go back to the idea of, if you lose a pound or whatever, often people will almost have a running count in their head. They kind of go, well, I did lose a pound last week. It fell out of my pocket when I was, sitting on a couch at a restaurant. But, 5 years ago, I did find 10 pounds. I'm up on that. They've all these little accounting silos, and they'll kind of say, well, it's reasonable if I spend more on this suit because last year I saved money when I bought those shirts on sale. So if you average it out, I'm coming to a decent price. And this isn't a good way of thinking. And an example on the screen here is during the credit crunch, or during the bull market leading up to the credit crunch, a lot of people thought of their houses. They bought a house, which is a place to live, and then every time they saw that it had gone up in value, they withdrew equity because they felt rich, and they spent it on other things. And maybe they even spent it on the house. They put new windows in, or put a pool in, or something like that. But this idea of these kind of siloed accounts, and it's not really a good way to think. It's not smart, but sometimes if you're gonna do this, you can maybe try to do it in a way that at least keeps you sensible, rather than something that justifies your bad spending. So that is mental accounting. So our next one up is that people tend to respond to positive actions with positive actions. And so there's a bunch of sort of studies here that people essentially reciprocate. If someone does something kind for you, you do something kind for them. And there's a really interesting book by a guy named Cialdini called The Psychology of Influence that talks all about that. And I'll try and put a link to that below. So it's a very interesting book. It's kind of a marketing book more than anything, but it's kind of about how people think. And basically people, it's human nature actually. If someone does something nice for you, you have an urge to do something back for them, and you feel unfulfilled almost. You don't like it being unbalanced, that you owe someone a favor. And that even relates to, I forget what religion they are, the people that sometimes are at airports and they'll hand you a flower and then ask you for money. And people have taken the flower and then or a pamphlet or whatever, and then they feel an urge to give money to the person because they don't want it to be an unfair transaction, And And the people who actually do this, they know it because, people take the flour and they don't want to carry around this flour, so they often pop it in the bin, and then you'll see the guys going through the bins, taking the old flours and bringing them back in and giving them to the next crew of people. And so it's kind of a behavioral trick that's often taken advantage of. But let's look at some examples of how this might work. So there's a bunch of these biases. How they're often found is through games, a little bit like the coin flipping experiment we had earlier, or the Kahneman and Tversky gambles that are offered to people. And so the ultimatum game, we're going to talk a little bit about this for a while, is a game often played in economic experiments between two players. And essentially how it works is that a sum of money is given to them with various rules, and they decide how to divide it between them. Now, in the first one, the first player puts forth how to divide the sum between the two players, and the second player gets to either accept or reject this proposal. Now, if they accept, they get whatever's been given to them. If they reject, neither party wins, okay? Now, the mathematically correct way to play this game is, of course, that if you are the person who is offered money, no matter what you're offered, you should accept it, because you're simply either going to get that or nothing. You've no real way and this isn't a repeated game, where you get to kind of keep repeating it and thus force the person to treat you fairly. It's a one-off game. And so if the second player rejects, neither person gets anything. If the second player accepts, the money is split according to the rule that was put forth by the first person. And as I said, it's a one-off game. So the recipient should accept any offer, as explained, but recipients typically reject offers below 15%. So we'll say if it's $1 and the person said, I'm going to give you 15 cents and I'm going to keep 85 for myself, many recipients reject that. Now, in truth, they're just getting the choice between 15 cents and nothing, but they'd rather punish the other person they'll essentially pay 15 cents to punish the other player. Sharers typically offer around 30%. Now, as a sharer, in truth, you should aim to offer a penny. If you knew the person would make an economically rational decision and accept any positive amount offered to them, you'd offer them a penny, you'd keep 99 cents, and game over, you've done as well out of it as you could. But they know that they're likely to be punished. So there's sort of an unwritten rule that people know exists in society that relates to having to reciprocate. And so, as I said, recipients are willing to pay to express their disgust at being lowballed. So that is the findings of the ultimatum game. Now, the next game up is called the dictator game, and it's kind of a spin-off of the ultimatum game. So, like the ultimatum game, but the giver gets to make a decision. And it can't be rejected. So the giver is given a sum of money and they can split it with the receiver. It's only played once, so the receiver doesn't get the opportunity to take revenge, right? So we'll say if it's $1, in truth, the correct strategy, like the economically efficient, the sort of wealth maximizing approach is just to say, I'll take it all and the other person gets nothing. And so the purpose of this is to see if people are rationally self-interested or if they're altruistic. And so the findings are, and this has been tested all over the world in all sorts of different cultures, and they find roughly the same outcome, which is that in all societies, people usually give about 17.5% of the money away, 70% give, and the average donation is 25%. So some people, 30% don't give anything, they do the economically rational thing. 70% do give, and of those 70%, they give an average of 25% of the money away. So that's kind of an interesting thing, it just tells you something about how people behave. So then the question is, do people in the real world behave like this? Because the problem is, of course, if you're in a game and you know you're being studied, maybe you behave differently. And that's often one of the criticisms of a lot of the research done in behavioral finance, is that it doesn't work in the real world. It just works in these test environments. But if people did behave like the players in the dictator game, you would argue that people would just be handing out money for no reason, right? Because they're just giving a sum of money, like they could keep it all, and they've just randomly decided to give it to this other person who's been randomly paired up with them. So you would say, well, in the real world that wouldn't happen. They're in a game and they don't want to look like a bad person, but in the real world they'd never do that. But equally, in the real world, people tip waiters and waitresses at restaurants that they might never go back to, right? Like if you're driving across a country, you might stop 10 times at 10 different restaurants that you'll never see the person at again. You'll order a meal, and if you were being economically efficient, you might say, well, the reason I pay a tip is that when I come back here the next time, the person will greet me nicely and give me good service because they know that I'm a good tipper. But actually, people don't do that. They tip anyhow because they feel it's socially accepted. It's the right thing to do. And it's back to that idea that one of our sort of behavioral biases is just that we tend to be nice and sort of kind to each other. And so that is, that's these two games in the real world. Well, let's look at one more game, the modified dictator game. And this is the same as the dictator game, but this time the dictator also has the option of stealing $1 from the recipient, right? So not only you're given $1 and you're told you can keep this, you can give some of it to the other person, or you can take $1 from that person, that's not nice, right? And this shouldn't affect the game much, right? Like the fact that you've been told that you can do that shouldn't affect the game much, because hopefully you're not going to do that, right? It should really only affect the 30% who gave nothing, right? Because in the prior dictator game, 30% gave nothing. So you're really almost wondering, like, what will this 30% do if they're able to now steal from that person? So let's see. Now only 35% gave any money, right? So that's roughly half the previous result. So once they've been told that they have $1 and you can give some of it to the other person, or you can steal from the other person, a lot of the people feel that not stealing from the other person is a kindness on its own, and that's good enough, So only 35% gave any money, half the prior result. 45% didn't give anything, so they just kept their $1 and they didn't steal from the other person. 20% stole $1, And so we have to ask here, what happened to all the altruism? Like this is kind of maybe a little bit of a dispiriting outcome. So the final version is dictator version 3, where the dictator is told that the other person received a similar amount and that they can give as before or can steal. The final version, I'm sorry, did I just do that one twice? The final version here is where both the dictator and the recipient have to work for the money. So you have to do something first. You're each given $1 for it, and then there's this option to give some of your money to the other person or to take some of their money. And this time, 28% took money and 67% neither took nor gave. And so what this tells us is maybe that people respect property more when it's been worked for, right? Because it's not really a game at this point. Now you're taking, at the last time it was tied into this idea that both had been maybe granted money and you get to take some of the other person's money. But this time you've worked for it and the other person has worked for it. And actually maybe in human society, we respect this more than we respect sort of random wins. Now, how does this play into finance, or have I totally drifted off the point? Well, there's a lot of research tied to paying employees in options and things like that. And historically, the idea was that often the CEO or the management team of a company would be given options. They'd be given an option grant to align their interest with those of the shareholders. But actually, one of the problems with that is it is granted money. It's not worked for money. And so maybe, it has, there's a lot of research now that suggests that maybe that isn't a great idea, that it doesn't work the way it was expected to, and it's just sort of ballooned executive compensation. But one of the takeaways here is that maybe if the CEO has to invest or is requested to invest some of their income into shares in the company rather than just granted shares, maybe then they'll behave more like a shareholder because they've actually, it sort of worked for money rather than granted money. So that's an idea to maybe think about. So the real world effects, let's look at the real world. So let's say if the CEO of an oil company calls you for advice, he's going to bid on some land for oil exploration, planned on bidding 10 million. He thought there'd be 3 bidders, but he's just found out that there's going to be 10. Should he increase or decrease his bid? Now, an interesting thing is that a lot of times people will say that this person should increase their bid. Now, I would argue, of course, that they probably came up with a bid based on some sort of a plan and some analysis of the likely value of this exploration property. But we get to this point, this is an idea in behavioral economics called the winner's curse, which is often that when things get bid up like this, that often the person who wins at an auction is sort of the loser. They won the product, but they may be overpaid for it, and so that can be a problem in certain events, that if you engage in a competitive project like this, maybe sometimes what happens is that you end up overpaying. You win, but you changed the price that you thought it was worth. So we'll say if the CEO decided instead of 10, now that there's way more bidders, he's going to bid 15. Well, maybe it's not worth 15. Maybe it was worth 12, and bidding 10 would have made a profit. Bidding more than that makes a loss, So that is the concept of the winner's curse, and that's often seen in mergers and acquisitions in the market, right? Where you often see that companies that buy a lot of other companies tend to underperform, and it's simply because they have this winner's curse problem. A great example was many years ago at the start of the credit crunch, RBS and Barclays got into a bidding war over ABN AMRO, and they kept bidding the price up, and of course the market was crashing. In particular, the market for banks was going down because of the credit crunch, and eventually Fred Goodwin, the CEO of RBS, they I guess won and ended up buying ABN AMRO, and a few years later they came out and admitted that it basically had a negative value, that almost they shouldn't have taken it for free, not to mind paid what they did pay for it. Endowment effect. So this is another effect, and maybe you can spot it in yourself. Suppose you won 2 tickets to the World Cup to see your national team play. How much would you sell them for? And is that price a different price than you would have paid for them? And often this is a thing that people do, is that once they have something, they think it's more valuable than if they didn't have it. Like if you're told, here's a pair of shoes, do you want to buy them? The person might say, well, the most I would pay is this. Well, if they say, you've just bought these pair of shoes, will you sell them to someone else who wants them more than you? And you might not be willing to, you might then decide that they're worth way more than you actually paid for them. And you wouldn't have bought them at that price, but because you own them, you've decided that they've suddenly now taken on value. And this is something that can be seen a lot in the world of finance and in the world of just buying and selling stuff. Our next one up, the dividend puzzle. So companies that pay dividends are rewarded by investors with higher valuations, even though it shouldn't matter, right? Because an investor shouldn't care if a company pays a dividend or not, because if you wanted some cash flow associated with the company, you could just sell some of your shares, right? Which is similar to it's economically the same as receiving a dividend. But for some reason, people view it as sort of a show of strength. It's like a peacock's tail, that this company is so healthy that they can afford to pay out these dividends, and thus it's signaling to the market that they're a strong company. And so often companies are rewarded for this, even though it doesn't actually make any economic sense. Another example is closed-end mutual funds often trade at a discount to the stocks that they're made up of, right? So a closed-end mutual fund is, we'll say an amount of money is raised to start this fund. We'll say if it's 100 million, that goes in and then they buy a bunch of stocks, right? Now, you can calculate the net asset value of that company, and assuming the stocks have neither gone up nor gone down, the pool of stocks might still be worth 100 million. But as this closed-end fund trades, often you'll find them out there. You're able to see that they often trade at a discount to their net asset value. And this is a puzzle, right? Once again, the efficient markets hypothesis would tell you that this shouldn't happen. Some people argue that it's investors adjusting for management fees, right? That they know that, yes, there's 100 million of assets in there, but that the guy running the fund is going to take 1% a year of that as his fee. And so actually, I'm only going to pay 98 cents on the dollar to invest in this thing. Other things are just uncertainty as to maybe the value of the assets is not exactly what we think it is. So there's many arguments as to why this should happen, but it is a thing that does seem to happen in the real world. The sunk cost fallacy, we've kind of covered this a little bit already, but an example of it, it's often known as the Concorde fallacy, because both the British and French governments continued to fund the development of Concorde even after it became obvious that there was no economic case for it, but it was just sort of well, we've put this much money in already, we can't just shut it down and look like we wasted money. And so sometimes there's arguments as to why the sunk cost fallacy exists. It's partially sort of a behavioral thing where you feel bad about sort of crystallizing a loss, but not only that, maybe you don't like losing face. You don't want to admit to the world that you put money into something and then you had to walk away for it and admit that it was worth nothing and that you had a bad idea, you were a bad decision maker. Intertemporal discounting. So this is another interesting one that a lot of people do. They discount rewards excessively as they move into the future. So, for example, if you tell someone that smoking is bad for their health and it might knock 10 years off of their life, well, when they're 18 years old, they're not as worried about that as when they're 80 years old. So something off in the future, people discount as being irrelevant. The alarm snooze is a good example of this, right? Because if you know you have to be up and to get somewhere by a certain time, you should just set the alarm for the optimal time. But a lot of people, they set the alarm maybe 10 minutes early and then they snooze it twice and they get up 10 minutes late and have to rush in the morning. And even the fact that a snooze button exists on an alarm, it sort of shows that maybe you have good intentions when you're setting the alarm, but then when it's time to get out of bed, you change your mind. So this is intertemporal discounting, and it relates to all sorts of mistakes investors make, even people under allocating to their retirement accounts, because they say that's way off in the future, maybe I'll win the lottery before retirement. And it's kind of often it's getting a bit late in their career and their investing life when they start really worrying about setting money aside for retirement, and they possibly should have been doing that from the first day they started working. Inter-industry wage differential, so another sort of behavioral finance issue. The law of one price holds in financial markets, and you would expect, we'll say, for example, like a qualified secretary, who does whatever administrative tasks and does them well, you would expect that person would earn the same amount of money no matter what business they're in. But maybe in certain industries, like we'll say the historically the oil industry or the investment banking industry or any kind of a glamorous, highly paid industry, they tend to earn more than they would in maybe if they worked at a recycling company or something like that. That's not exciting. And this doesn't appear to make sense. Like, why would a company pay more for a given task than they need to? But they tend to. And one argument is just that it feels unfair to pay a colleague. Like, if everyone else is well paid, it sort of feels mean-spirited for the lower paid employee to be doing so much worse than everyone else within the firm. And so it often is better to have an unskilled job at a hot industry than to have a low skilled job in a low skilled industry. So what else have we got? Calendar effect. So a calendar effect is any economic effect, usually in the stock markets, which relates to the calendar or the time of year. So that's back to these sort of January effect type things, or a turn of month effects and so on. These are, there's a book or a website out there called the Stock Market Almanac that sort of tells you the expected return of the stock market for that day every year. I'm not sure that it's huge value added. It's a thing that people sometimes look at. This is the sort of thing that people look at in the world of behavioral finance. There is a big risk of data mining here, where you'll just sort of find something that is an artifact of the data rather than something that relates to a real investor behavior. And usually when you're doing this kind of behavioral research, you're trying to find something that people actually do that might increase your returns. Like if you've worked out that there's a particular investor behavior that they're making a mistake, and if you don't make that mistake, you'll be profitable. But sometimes these things can be data mining more than they are actually useful. Price stickiness. So we talked a little bit about this already, but you often find this. It's a thing in economics where prices are resistant to change, and we sort of talked about it earlier about not inflation adjusting things, but equally things like wages, house prices, and so on tend not to change as rapidly as the economy changes. So we'll say even right now, with the whole the big market sell-off that's just occurred relating to COVID-19 and the shutdown and so on, you might expect things like house prices to be marked right down. The stock market is down 30%. If you're going to sell your house, shouldn't you mark it down 30%? But actually, people are very resistant to doing that, and it's just that they feel that the fair price is the price that it was before, and they're stuck to that price, and they'd rather not sell it than to mark it down. There are reasons in their money illusion, as we explained earlier. There's also this concept of menu costs, that will say, for example, if something varies on a daily basis, does a restaurant put, the way sometimes you'll see on a menu, it'll say market for things like lobster or something like that, something that might have a volatile price. And so, often maybe they don't, people don't want to change the price constantly because it's, you have to keep updating the prices on your website or on your menu or whatever it might be. And so you just pick a high price and you stick to it for a long time. And maybe, that's also relates to the kind of 99-cent items on fast food menus and so on. So what else have we got? So in dealing with clients, is this behavioral stuff useful? Well, it is, because if you know the kind of mistakes that people make, you can kind of guide and educate them and hope that your job often, if you work as a financial advisor, your job is to help people not make the mistakes that the average person makes. And often we find that once someone is told about these biases, once they're explained in a non-insulting manner, that people will adjust. They'll go, I see, I could see how I might have made that mistake, but now that I know the correct approach, I'll follow it. And it's often found, there was a study a while ago where a bunch of a bunch of actors were sent into asset managers, and they went in and said what their current asset allocation was. And you would think that the private wealth manager might then say, well, that's either too conservative or too risky for someone like you. But in general, they didn't. They just agreed with the client's asset allocation. Now, there's two arguments. One is you could argue that they just are doing a bad job. That's one argument. The other argument, though, is also that they are pitching for business. And if you tell someone that you're going to change everything, maybe you'll lose out on that business. So maybe you kind of sell to them, you get them in, you make sure they're comfortable, you get to know them, and then you pitch your ideas to them. So that could be an argument, but it's interesting. So when should advisors attempt to moderate the way their clients naturally behave? Well, for example, if it's a behavioral bias that you're able to kind of explain to the client that there's sort of simple mistakes that we all make, often that can be changed. But sometimes we'll say, for example, if it's just something core to the emotions of that investor, if they really, really are risk averse and they really don't want to change, well, then it's reasonable to, the whole goal of managing their money is to manage it in a way that suits their needs and their risk tolerance. So that is that's that. So finally we get to, is efficient markets hypothesis right for the wrong reasons? Well, is the difficulty in gaining an edge due to the prices instantly discounting all known information? That's the argument of efficient market hypothesis. Or is it tied to the impact of emotions where neither market prices nor investment behaviors are rational? So maybe the reason people aren't outperforming is not due to the fact that markets are perfectly priced and there's no point in trying to outperform. Maybe it's that your emotions just get in the way of doing the right thing, doing the smart thing. And so maybe the problem, maybe efficient market hypothesis is correct, but in that people tend not to outperform. But maybe the reason that people tend not to outperform is not so much that everything's perfectly priced, but that people's behaviors or their emotions get in the way of doing the correct thing. And so if biases fall into two broad categories, cognitive and emotional, we could say that the cognitive biases come from faulty reasoning, and therefore better information and advice can often correct them. Emotional biases are maybe just more difficult to correct. And so I often argue, like, one of the reasons, my background is in quantitative investing, and one of the reasons that I like investing in a quantitative manner is that I get to sit down and come up with a plan, like a written down plan as to what I will do, and if things go right, how I might change, and if things go wrong, how I might change. But I like to sort of have a plan like that. And so often one of the better ways to get around a lot of these biases is to have a good plan. Like, if we'll say, for example, if you buy a stock, do you just buy it and say, and now I'll get rich? Or do you say, if it goes up by this amount, this is what I'll do. If I lose more than this amount, this is what I'll do. And maybe if you had a plan to start with that was lacking in emotion, maybe you could then stick to that. But if you don't have a plan, maybe you won't make the right decision. So our cognitive biases are a lot of those sort of rules of thumb heuristics that we had earlier. And then emotional biases are things like regret, lack of self-control, loss aversion, hindsight, denial, that kind of thing. And so, as I said, these ones are maybe harder to deal with than the first ones. Often when a wealth manager brings on a new client, they get them to fill out a questionnaire that gets them to detail their risk tolerance and their investment goals. And that sort of helps the manager to understand what the investor's goals are and what their risk tolerance is. It's worthwhile noting that often people think their risk tolerance is really high in a roaring bull market, and then in a bear market they quickly decide that they don't have that risk tolerance. So it's often not always that valuable to say, do you want an aggressive growth, a kind of high risk portfolio, because a lot of people often think that high risk doesn't involve losses, which of course it does. And so my argument is often that statistics is the basis of all science, that sort of doing this numerical analysis will help you maybe to make better decisions than purely emotional decisions. And so I would advocate that in investment analysis. This knowledge is useful. It can help you counteract your natural tendencies, and we all have these natural tendencies. It can be helpful to have a long-term viewpoint, and we need to keep in mind that current market events are often different to past events. So there's often people will kind of, once a crash has occurred, there's a group of people that's always looking for the next crash, and they always think it'll happen in the exact same way that the last one did. And that's not usually, they're always different. avoiding biases is worthwhile in investing. I won't read a whole slide out to you. But, some of these biases are good for us and some are bad for us. And sometimes it's good to be conservative, and you have to match your investment portfolio to your risk tolerance and to your goals. If you're, sometimes you might admit that we'll say for that example where you had a 100% chance of $1 million, or there was a chance of 5 million, or 89% chance of the one, and I forget the numbers, but maybe if you just admit that you're the kind of person who doesn't like to gamble, you can do the calculation. You can say that there's two different present values. I'll take the lower one because that's the kind of person I am. I would regret it too much if I was in the 1% who got nothing. But it's good to own up to that rather than to say you're doing one thing and do the other. And so, as I've been saying, often the best protection is to have some sort of a plan, and that way you might sort of march towards your goals. And then this is one of my favorite quotes ever from Mike Tyson, which is, everybody has a plan until they get punched in the mouth, which is a great boxing quote. And something to leave with you is that often, even when you have a plan, the problem is that you then want to change your plan the minute it doesn't seem to be working out. And so on that note, I'll let you go, and I'll see you tomorrow with a new video in Applied Portfolio Management. Talk to you then. Bye.